You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome back to Options Playbook Radio, the program here on the network where we typically break down options plays from A to Z, tell you how you can use options offensive and defensive plays in your own portfolio. Going to mix things up a little bit here for today's episode. My name is Mark Longo, of course, from the old optionsinsider.com, as well as, of course, on the Options Insider Radio Network. If we sound a little bit different, it's because we're not coming to you from our Chicago studio or even from the Ally HQ. We're actually down here at the Options Industry Conference in scenic and sunny Florida. One of the great things about this conference is it gives me a chance to get in the same room with my old pal here from Options Playbook Radio, Mr. Brian Overby, the senior options analyst, easy for me to say, kind of just the options guy over there at Ally. Brian, welcome back to your own program. Good to see you in the flesh.
All right. Yeah, always great to get together and talk about what's going on in the industry. It's amazing how tiny this group is, and it's literally like going back to homecoming in your high school days.
I joke all the time that it's the same faces with different business cards. No one leaves the business; they just change firms all the time. So, now you're with firm X, but no one leaves the business. It's a pretty good business to be in. So they tend to stay. They just switch firms all the time. So
I agree with
same
that.
faces every year. But Brian, of course, this is the Options Industry Conference. So this is the conference where the exchanges, the brokers, the vendors, kind of everybody gets together and talks about the state of the options industry, the state of the options market, and some of the pressing issues therein. You guys are obviously down here this year. You guys have been here for a number of years now. What is it that brings you to this conference, and what are some of the pressing issues from your guys' perspective over there at Ally?
Well, one of the biggest things that we're looking at is new firms, new products, new avenues of business, and always trying to push towards getting better fills for our clients and talking to the actual exchanges about payment for order flow, what's going on in that field, index trading in general. That's what all the exchanges are here, and they're really pushing the index trading, how they can make that more enticing for our clients. A couple of conversations I've already had with some people that are sponsoring this event, the NASDAQ, and talking about new products. If we're going to introduce new products, how can we do it in a way that it's enticing for retail clients to trade them?
What are some of your thoughts on that? What are you hearing from your clients? Because obviously we're down here at the conference, and liquidity is a big topic. In fact, we asked our audience, Brian, before we came down to the conference. We like to take their pulse and see what they want us to talk about, and we gave them a few choices. We said listing crypto options, kind of just for fun. I thought, quite frankly, that would run away with it, but it did not. We also gave them the choices of options, liquidity issues, after hours for options, and a number of other things. And so far, with a few days left in the poll, 44% saying options liquidity issues are their number one concern, what they want this conference to be about. Are you hearing that same concern from your audience? Are they starting to see, and we see the data here every year, somewhere around 19 names account for about half of the entire business. And once you get outside that top 19 or 20, it tends to get somewhat sparse, particularly if you're trading, not front month at the money. Are you hearing these same concerns from your clients? And what are you guys over there at Ally, what are you guys trying to do to help correct this?
Yes. Overall, the answer to the question is yes, yes, and yes. One of our biggest group of clients are our registered investment advisors that actually use our platform to trade through. And actually, we've changed up, we've had this conversation so much that we've actually changed up the way our chains are deliver data. In other words, back in the day, you'd type in IBM, and the very first expiration would come up, which would normally be a weekly in this day and age. And Apple, the FANG stocks, whatever you're talking about, you're always going to have a weekly pop up. They wanted to make sure that we did the normal monthly expiration. And it's mainly because they teach a specific strategy, some of them, and it's just simple covered call writing. But they want their clients to be trading in the monthly product because they're doing a lot of market orders as opposed to being in the weekly products. And why is that? Well, it's flat out liquidity, the VIG, the bid-ask spread. They felt like their clients weren't getting good fills, especially if they were doing market covered call orders, market cash secure put orders. So we actually changed up. So if you go into the Ally Invest and you don't have any dynamics in and you just click a chain, the first thing that you're going to see is the very first monthly that's available. And I feel like I should kind of explain part of the reason why they think, or we as an industry kind of feel like the monthlies do better, is that they've lived longer. The weeklies are literally every week one expires and another one comes up. But the monthlies, as part of their rotation, start out as a 9-month option contract at least, if we're not a leap option, and they've lived that entire time period all the way up until that expiration date. So that lets them build open interest, and obviously you get a little bit more volume in that area. And then on top of it with the weeklies, we're seeing half-point strikes in some of these stocks now. And so you're getting borderline stocks like, I'm going to call a borderline stock be a Walmart. And you're getting all these weeklies. It trades good volume in the stock, and the actual stock is very, very liquid. But you're seeing when you add the weeklies and then you do 1-point strike in the weeklies, and then the weekly becomes a monthly weekly, and that goes right along with the monthly. You just have so many products. It's adding we're actually going backwards on bid-ask spreads and VIG that are going towards those exchanges. And I just would like to see them, if we're making these new products, make it realistic on the strike prices. Make don't just open it to open it. You know, there's got to be some interest there and some need for a half-point strike in a $50 stock. And I just don't know why you would ever need it, but the exchanges sometimes think they do.
You know, it's funny. You're right. That has been the trend for years now, is just short duration. But you're right. When you start adding a full strip, now you have 4 options as opposed to just one monthly. And maybe you have several months worth of monthlies. Now you have 8 instead of 2. That's just by definition is going to fragment a lot of that liquidity. And then on top of that, you have things like auctions that are helping as well. I'm curious. I don't think you and I have ever sat down and chatted about these PIP, these price improvement auctions. What are your thoughts on these? People seem to be pretty divided on this. Some people think they're the best thing since sliced spread. Other people think they're the worst thing to ever happen to the options world. Where do you fall on this?
You know, I'd say that it falls somewhere in between. I'm not going to say that they are the worst. I think we still need some time to figure out exactly where they're at, and the liquidity of them is still not huge. And as we get more liquidity, ideally the concept of price improvement shouldn't even exist, right? The market should be what the market should be. So you're trying to solve a problem that, in my mind, if the liquidity is there, it's not a problem. It almost reminds me of going back to the minis when we talked about trading mini options on stocks like Apple. Apple was a $700 stock, and we decided to split the stock, and now you don't need minis. Yeah. You know, so we solved a problem that really wasn't a problem. Apple just needed to switch their stock up. And so I don't like situations where you're trying to fix a problem that shouldn't really be a problem.
It's funny. You think of auctions in that light. You're right. It is kind of a tacit admission that the liquidity there isn't good, or it needs some help if you're launching auctions on them. And you could see the thought process behind them it had some good intentions, trying to protect the dwindling supply of market makers that were out there by saying, hey, you don't need to show your best hand. But guess what? they're not showing their best hand. So now we have spreads widening out. We've seen some great data. The guys at Oratz on our site have provided us with some great data just about how wide things are just in between the August 2015 sell-off, which is about 4% in the S&P, versus the big sell-off in February, which is also about 4% in the S&P, and how much wider things got now versus back in August, and how much less liquidity was displayed on the bid and ask than there was back then. And those kind of trends are somewhat alarming. So, yeah, there is a lot, I think, of work to be done there. Ironically, Brian, the other thing our audience seems to be obsessed with, so on the one hand, they're obsessed with liquidity during the day, saying it's not very good. On the other hand, they really, really want after-hours trading for options. A little bit counterintuitive, you might think, because, one's definitely not going to be very liquid. But still, that's, you guys, we hear this all the time, so you guys must definitely hear this in terms of the retail crowd in particular. Around this time of year, around earnings season, we hear it the most. The typical example I always bring up, we hear it all the time. Hey, I bought a call before Google earnings. Stock moves 80 handles in the after hours, and it opens unched. And they'd go crazy. They lose their mind because they watched all that money just go away, and then they write to me, and maybe they write to you very angry, like I can do anything about it. So they tend to vent this time of year. But obviously it's an issue a lot of them are still interested in. Do you think this has any legs? I know you guys in the retail space are clearly for it because your clientele wants it. Do you think the industry is starting to get the message that maybe to lean toward this, or is it still a non-starter?
Well, let's see. If Google decides to announce earnings daily, I think it's going to be. I think that would be a great
daily
product.
Earnings,
right? So every day, and that's the issue. Is yes, there is a time when they are there, but when there's no major news, and then let's say a company comes into the news, like you get a spill. I'm thinking of BP back in the day, like you get some oil spill or something. Stock starts rocking and rolling, but then it goes away. So what do? Do you just close them down after they die? And it's not like the exchanges haven't tried this. They've dipped their toe in the water time and time again. It's specifically on indexes, and I can almost see it more on indexes. I think our retail clients like to do it on the big stocks, like you mentioned, the perfect scenario where they would want to do that, and that's probably the one time when the liquidity would be there. But we still have, even, just good stocks overall still have liquidity issues, and then thrown in the after hours market. I almost in some instances worry that retail clients aren't going to be astute enough to understand when it's a good thing and when it's a bad thing to be trading in that marketplace. But a lot ignorance is bliss. You get a fill on it. You go out and your option, you want to sell it for $15 because it made a big run up, and you get your $15. You might have deserved 20, but you got your 15, right? So most people don't really realize that if the market was tighter, they would have got a better fill on that trade. So I'm leaning towards, at this stage, not adding more. I'd like to see the markets back off and start doing less and less products. The biggest thing that has happened is we now have unlimited quoting. Like, the quoting was a big issue, and it was a big reason why all these products weren't getting introduced. The symbology of the options limited what they could do. And now that we have it, the sky's the limit. We got the data, we got the servers that can handle it, and it looks like the exchanges are just going to go there.
Yeah, it is. So it sounds like you're saying we'll get our house in order intraday first before we add extra legs. What about maybe something like a limited baby step? Like you mentioned daily earnings for Google. That'd be kind of funny. But what about maybe like a limited pilot around earnings? So like maybe that earnings week and that's it. Or maybe limited even more, maybe only closing, something like that. So you could reasonably assure that there'll at least be a little bit of a baseline of liquidity there for that small limited time, and then you expand from there. What about something like that, like a pilot?
Yes, I'm going to say in general yes, and that's just a gut reaction to that question. I wouldn't mind that at all, but I can't fathom the exchanges are going to go through that just for that instance. So they got to set up the marketplace, they got to do the quoting, and then all of a sudden it's gone. And a lot of things, like I see a lot of the exchanges do a lot of things just in general when it comes to just trying to get the word out. Like I look at the SPX chains for the CBOE, my old stomping grounds where I used to work at. But they go in the SPX and they try to stick every single product that has ever been invented in the SPX under the symbol SPX. And it's because of marketing, because they're worried that if they change up a symbol a little bit and make the chains more understandable, that people aren't going to find out about it. So I think you have a marketing problem if you do something just around earnings, and also a market setup problem. So I still think it would be a lot of cost, but you'd find out. I guess you'd find out. If the market can't sustain something around earnings, then it's just not doable.
Well, Brian, you came all the way down here to Florida. Anything else top of your mind, or maybe for you guys over there, your team at Ally, that you really want to get on the drawing board here for the conference, or are you kind of here just to get the lay of the land?
Well, it's always good to come here. Mainly, gosh, it's just the little conversations around the water cooler, but down here are around a nice pool with a good little bar next to it. So these conversations are invaluable. You know, you understand, you get to learn what other people in the industry are doing in a casual conversation. There's nothing hitting, everybody's open, everybody wants to help out everybody else. And that's the biggest reason why we're here as Ally Invest. And also learning, every once in a while I always learn something new, a new way to route something that's new that's coming to the marketplace. So you want to stay involved, and this is the perfect event to do that.
Well, we'll look forward to hearing what you discover at the conference, maybe on some future shows. And if you want more content from the conference, listeners, stay tuned to the network. We'll have a lot of great interviews coming your way very soon.
The Options Playbook was brought to you by Trade King Group. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to tradeking.com/ODD to review additional risks involved with trading options. Securities offered through Trade King LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.